Thank you for joining us for another edition of the Market Commentators podcast. My name is Andy Wilms, and I'm President and CEO of the Milwaukee Company. And joining me this morning, as always, is Mike Wilms, who is the Milwaukee Company's Chief Operating Officer and Compliance Officer. Good morning, Michael.
Good morning, Andy. How are you?
Very good. Thank you for joining us today. Appreciate it, as always. And just for our audience, a quick reminder that nothing in this podcast should be viewed as investment advice, and that the views we're going to be expressing today represent Mike and my personal opinions and not necessarily those of the Milwaukee Company. And with that being said, I think I'll get started with a market recap of what's happened since we last spoke, which is our normal way of proceeding. So let's just begin. The Wall Street has kicked off August on the right foot, with the Dow Jones Industrial Average, the S&P, and the NASDAQ all notching solid gains in the first week of the month. A big part of those gains were being driven by strong performances from key tech companies that we all know and love, Apple, Microsoft, Facebook, all of which were up by more than 3% last week. And yet the Dow was the top performer with index-wise, that index was up 3% last week, while the other NASDAQ and the S&P were down somewhat less. On Monday of this week, energies and industrials, two of the worst performing sectors of the S&P, outperformed with gains of more than 2%. While Facebook, Amazon, Netflix, and Microsoft all declined. So we saw a little sector rotation there going on, it seems. And the result, a quarter-point gain for the S&P and a 40 basis point drop for the NASDAQ. Then on yesterday, we saw the S&P close lower for the first time in I think it's 8 days, as big tech again drove the average lower, with the index down 80 basis points for its worst day since July 23rd. The NASDAQ fell by 1.7%, while the Dow Jones Industrial Average backtracked by a little less than 0.5%. So that's where we stand since our last meeting on the market. Mike, can you fill us up on any recent developments that have occurred with regard to the situation with the COVID pandemic?
A lot of the market volatility yesterday, and the reason markets started up was on the news release that Russia and Vladimir Putin were chirping about the fact that they have an approved coronavirus vaccine. Everybody is committed to finding an answer, and there's just some conflicting information out there, and I guess we just need to hope that it's sooner than later that a vaccine and hopefully a therapeutic is brought to market.
Great. Well, I guess mixed bag. We'd like to see the infection rate drop faster, and the number of deaths certainly drop faster. I think we were making good progress on that front until yesterday, when the number of deaths sort of spiked. But all in all, I guess it's consistent with what we've seen so far. On the economic front, it was kind of a light week last week. We did get an announcement from the Labor Department that payrolls increased by 1.8 million, which topped expectations, and that the employment rate dropped to 10.2%, which was a little better than expected. The lion's share of the employment gains came in the hard-hit leisure and hospitality sector, which added 592,000 jobs. But those jobs, I think, are in jeopardy if the virus continues to spread, because there's continued rollback that could really affect that number in very short order. And the government and retail jobs also saw a sharp spike last month. And then the only other major development, I would say, on the economic front was President Trump signing executive orders. We've all heard about that, because since Congress has been unable to come to a deal, he decided to take action unilaterally, and his measure includes an eviction ban, a payroll tax suspension, relief for student borrowers, and a $400 a week bonus for unemployment benefits. Whether or not this will actually hold up is a whole other question, because, as we all know, the Constitution gives Congress the power of the purse, so to speak. And so the president really doesn't have the authority to spend money. So we'll see if anybody has the nerve to challenge his authority to do what he's done. I suspect you might see some conservative Republicans break ranks and question his ability to do that.
I think isn't the plan to redirect some of the funding that's been appropriated for FEMA? And so it's not like it would be new spending. It was appropriated. It's just that it would be redirected. But that still would be subject to a legal challenge also, right?
Right. And I don't think the amount that they could reappropriate would be sufficient to cover everything that he's proposing. I think that would, address some of it. But you can't, FEMA's not, sitting with piles and piles of unspent money. Right. Especially with the hurricane season.
Numbers are under the initial appropriation. It was $268 billion for unemployment assistance at the federal level, and FEMA has got just under $50 billion of unspent funds that he's trying to redirect. And it's all about trying to put political pressure on both the Republicans and the Democrats to get together and pass legislation to address the issues.
Right. The problem, of course, is you have this, difference of opinions going in three different directions, right? Because you have the Democrats, of course, wanting to spend more, some Republicans willing to spend, some money, but not a ton, and some Republicans saying, listen, we've already spent way too much, which is, I think, take us to our first topic today. Congress has pumped about, 3.6 trillion early on into the economy, which in effort to try and stimulate it and ward off a great recession again. And but that amount, dwarfs what was spent to fight the Great Recession and actually increased household incomes. And now we got Congress again, as you point out, considering what could be a fifth package of stimulus, adding another $1 trillion to the tab. And some economists saying, that's not going to be nearly enough. You're going to need to spend a lot more than that to really keep the economy from slipping into a Great Recession. So my question to you is, do you think the amount of stimulus paid so far has been about too little, too great, or just about right? Kind of like the...
Well, I mean, once again, I mean, the devil is in the details, and it's really kind of hard to understand. But if you take a look at the U.S. savings rate, it had, going back to 2015, bounced around between 7% and 8%. There was a couple of months in 2017, I believe, where it ticked up over 8%. But in April, when the first major rounds of stimulus hit, the savings rate went to 32.2%. So a lot of the stimulus actually wasn't needed for current spending and was banked by the recipients. And that savings rate dropped to 23.2% in May and 19% in June. And as an indication of the kind of impact that the COVID lockdowns are having on employment and the functioning of the economy, the Bureau of Economic Analysis was due to report the July numbers at the end of July and did not.
Right.
So I would think that it's really hard to say. Has it been too great? No. Has it been too little? Probably not. I mean, the magnitude is unprecedented. But I'm not willing to say just right because I just don't know.
So, okay, maybe we should go into politics. That sounds like a political answer if I've ever heard one. Just kidding. But when you break it all down, I think you have to evaluate it on what the Fed has done and what Congress has done. The Fed controls monetary policy, which basically breaks into interest rate cuts, loans and asset purchases, and regulation changes, right? And so on the monetary side, I think the Fed has done a much better job than the Congress has done on the fiscal side. I mean, the Fed,
Yep.
yeah, the Fed cut interest rates from to 0.25% overnight rates. I think that was a good thing. They said they're going to continue their loans and asset program as will stay open ended and do as much as needed to keep the economy running smoothly and the markets functioning properly. I think that was a good statement to say. They've aided financial institutions by pumping about $2 trillion into them through Treasury purchases. They've opened up some specific lines of credit to financial institutions. They came out with a loan program to give banks the money to lend for the payroll protection program and for small businesses, and that's worked out mostly very well. And they've even gone so far as to step up and buy corporate bonds, which, as we all saw, what happened in the corporate bond market was tanking, and then they rebounded. So I think the Federal Reserve deserves, an A, and I would say they've done just right. Congress, on the other hand, I would be reluctant to give such a high mark to. I mean, if you look at what they did, Congress really controls fiscal policy, which goes back to what we talked about a moment ago. That's the power of the purse. How much money you're going to give out, how much money you're going to collect. That's what we're talking about when we talk about fiscal policy. And in that regard, they added additional unemployment insurance for the states. I have no objection with that. They gave everybody a direct payment of $1,200 a person plus $500 person per child. I think that was probably overboard because not everybody who got that check needed it. I mean, we both know of people who died who got the check and people who were doing very well, they got the check. So that struck me as poorly handled. They gave everybody $600 of additional unemployment per week until the end of July, and now they're looking to extend that, which meant people were making more money than when they weren't working than what they were. I don't really understand the logic of that. It makes it awful hard to get people to come back to work when they can get more money staying home. And they gave mortgage forbearance for federally backed mortgages for 180 days. That one I don't have a problem with. So, and they did some grants to state and local government. So that's basically what they have done. So I would say, on average, I would say Congress has probably done too much in some of the programs they did, or at least weren't careful enough with how they spent the money. So Federal Reserve did just right. Congress, I would say, probably wasn't careful enough.
I agree with you 100%.
Great. Well, that's unusual, but thank you.
Yeah.
So let's talk a little. Let's go from policy to some investment concepts here and focus on that, what it means for our clients. And one of which is that all this money that is being pumped into the economy could be, really lead to a rise in inflation and interest rates. And it seems like more and more people are expressing a concern in that. Do you think all this government spending is going to point us in those directions, or what are your thoughts about that?
Well, I mean, there's really two types of inflation, and first being, and it's the one that comes to mind, people in our age group, is consumer price inflation. The cost of goods go up, and then the second is asset price inflation, which is probably what we've experienced going back to the QE around the financial crisis. The thought is the dollar or the excess money supply will morph into wherever there's a vacuum. And asset prices seem to have been trending to higher valuations given the increase in the money supply going back to 2008, 2009. You've got $5 trillion on the sidelines right now in the money market funds in this current environment after the Fed has bought $2.7 trillion worth of risk assets. So the risk for consumer price inflation is what we need to be concerned about relative to interest rates and how interest rates are affected by an increase in inflation. The virus has had kind of a mitigating effect on both supply and demand. As parts of the economy were locked down, manufacturers were closed, and there were supply issues. And the place where that became pretty evident was with meat prices, with the meat packing plants that were shut with COVID breakouts. But on the flip side, with the concerns about spending and future employment and so on and so forth, the demand side has been equally impacted. I mean, people aren't out in entertainment venues. They're not out buying cars, and so on and so forth. So there hasn't been a real tip in one direction or the other from a supply or demand part of the equation. But I think that given the savings that have taken place, if all of a sudden there was an all clear on the virus front, the tick back up in demand could be pretty substantial and very rapid. So, and that would be a concern to me personally on the inflation front.
Okay, well, with that being said, I guess, my gut tells me that inflation and rising rates are a real risk, and that the dollar's recent decline could kind of be a canary in the coal mine, sending the signal. So I think it's reasonable to hedge against that risk by increasing allocations to shorter bonds and maybe looking at tips. I also think where it's practical, individual bonds and defined maturity date ETFs may be preferable to perpetual mutual maturity date ETFs, which do not guarantee the return of principal, of course. And that all being said, I recognize that you and I could both be wrong. I had, and I think you did too, had similar concerns in 2008.
Yep.
But the rates of inflation remained low, so I wouldn't go out on a limb by betting that rates will rise or inflation will come back. I'd avoid putting a stake in the ground. I
think another canary in the coal mine here is the price of gold, and the rally to an all-time high in gold. It has been directly linked to inflation expectations.
All right, good. And now quickly, because we're running a little long here, the S&P is on the verge of hitting all-time record levels, and technical analysts who watch stocks more closely than fundamentals says that fundamentals do, which I tend to focus on, say there's some very good signs of strength in the latest move, and the S&P could move higher even from here, even though valuations are getting very lofty. And so do you have any thoughts about the risks of investing in equities when the valuations are this high, but the technicals seem positive?
Well, we're a little over halfway through the earnings season for the second quarter on the S&P 500. And a big part of the analyst rhetoric around performance in here for the S&P as a whole has been the earnings beats. Historically, it's about a 3% beat over earnings estimates. The second quarter, while everybody took their estimates down very severely and the companies pulled guidance, the earnings releases have exceeded estimates by 22%. And right now, where the market's supposed to be forward-looking, people are talking about operating leverage and the ability to cut expenses that everybody went through here in the second quarter relative to the virus, whether it's eliminating your travel budgets, it's renegotiating rent with the weakened position the landlords are in. But the big one is if somebody has been furloughed, do you actually permanently eliminate the positions? So, the bull argument right now on the S&P continuing to move higher is around operating leverage and earnings improvement. And I just don't, I'm not 100% sure that's going to be how things play out.
Okay, great. Well, I'm looking at, from a valuation standpoint, the CAPE is now the cyclical asset price ratio stands at about over 30, where the 20-year average is 25. So, and if the CAPE were to return back to its 20-year average, its historical average is much lower, but 20-year average is about there. It would have to drop about another 12%. So it's clear that valuations are high, and that's just not limited to the United States, but globally as well. According to the so-called Buffett indicator, which stock markets consider to be overvalued when the ratio of stock market capitalization to GDP rises over 100%, and we're there now. So,
yep,
the markets are definitely expensive. But the other point is that expensive markets can go higher, right? Just because a market is expensive doesn't mean it can't go. And there could be periods of high valuations that can last for many years. But as I've said often before, the potential upside decreases as valuations get higher, and the potential downside increases as valuations rise. So it's something to be very careful about, and I do think it's worthy of reconsidering asset allocations if you're trying to keep your risk level constant, if that's your objective. Okay, well, with that being said, I think we'll wrap up. Thank you all for joining us today. Keep in mind that you should not act on any of this advice unless you've talked it over with a qualified financial professional who is familiar with your personal situation and investment objectives. And with that, I will wish you all a great day.